Yo, it's Midas. Let's talk about the great market crash of 2026. This is what no one is telling you. You need to save this video, watch the very end. So disclaimer, everything said in this video is only for educational purposes. Make sure to always do your own research. This is why you listen to Midas while I beat the S&P 500 by 103x in less than a year. If you want to take a look at the proof, you can take a look on my link in bio. It'll show you the data of my calls, the tickers I called, where the call was posted, whether it was YouTube or TikTok, and my total gains, which is over 5,000%. Let's get to the video. So, if you have been living under a rock, you would know that with the stock markets recently, pumped up very, quite a bit because of the Fed cutting rates. But people are understanding that when the Federal Reserve cuts interest rates, they cut it because of economic reasons. So they cut it by a quarter point as job market weakens. That's not a good sign for the economy. It might be bullish for stock market because you're able to, borrow for cheaper. Therefore, people are going to spend more on to riskier assets because they have, it's cheaper to borrow money. But at the same time, though, the Fed doesn't cut rates just to pump the markets. They cut rates because they need to for the economy to survive. So, what is actually going on with the Federal Reserve cutting rates? Well, the Fed just cut rates by 25 basis points, which is 0.25%. This is, the first cut since December. Powell called this a risk management cut, citing signs of labor market weakening. This means the Fed is worried about jobs, not just inflation. And the Fed signaled that there could be more cuts later in the year, possibly two more. But, the governor wanted a larger cut, showing that there's tension in how aggressive the easing should be, as well as with Trump, also basically pressuring the Federal Reserve to cut rates. And everyone wondering, I've been posting about this, bear market crash on TikTok, on Instagram, and you might be wondering why exactly this could be a setup for a crash in 2026. Well, rate cuts can be a red flag, not just a relief. So cuts often happen after the damage has already started, like, jobs weakening, consumer sentiment dropping. So by the time the Fed cuts, some of the worst effects may already be, priced in. But this cut was explicitly tied to labor market weakness. That's just a slowdown, not just we want cheaper money, therefore the market should just go up. And remember, the market does not go up forever, despite what anyone thinks. And despite cuts, inflation isn't fully under control. Many sectors still face input cost issues, supply chain disruptions with tariffs, and geopolitical risk. So cutting too early or too much can reignite inflation pressures, which could force the Fed back into hikes or cause bond market yield to spike. And there's a risk of overextension or these, frothy valuations, where markets are already trading near record highs in some areas, especially S&P 500, which has already been hitting all-time highs in just the last few days, as well as quantum AI stocks, as well as, nuclear energy stocks, just hitting all-time highs despite companies being in pre-revenue. That is insane, and that's a hint for you OKLO holders. I got it at $6, and I even think that company is very overvalued. But many investors have already priced in more rate cuts, which means expectations are very high right now. But if these cuts don't materialize or are smaller than expected, disappointment could trigger steep drops. Sectors like tech, especially AI, high PE stocks like Palantir, Big Bear AI are more sensitive to these rates. Higher discount rates hurt those more when rates aren't falling fast enough. Keep that in mind. So, tech is extremely overvalued right now. And think about it, how is DOA forgetting IONQ? These quantum computing companies still a thing in 2025 when the tech is barely realized. I know D-Wave already has those, you know, quantum computers that you can use in various companies. I know it's like on the cloud. And while regretting IonQ, it's still, in development. But even then, the revenue is only like 3 million for a $9 billion company evaluated, that's insane to me. And I feel like that should not be a thing. And the stock now, D-Wave $30, Rigetti $26, IONQ 76 off the top of my head. I believe there's going to be a huge crash on these speculative technology bets, despite being very bullish on the technology itself in the future. I just don't think that it should be this high, especially in 2025. Another comment I want to make is how is OKLO, a nuclear energy company, that is pre-revenue, hasn't produced any energy or revenues, has a $17 billion valuation. That is just insane to me. And I don't think that is sustainable in the long term. People are just betting on this speculative stock to just go to $200. I don't think it's going to happen. If it does, I believe a crash is more due for these companies I'm talking about. And these more cuts, so this is a common argument about more cuts does not equal guaranteed good times. The Fed's projections show more cuts, but guidance is cautious. Powell warned that these projections could change. That uncertainty itself can spook the markets. You already seen it with, Jensen Huang, CEO of NVIDIA, saying that, quantum computing is not there yet. You got to wait a couple of years, and the stock just crashed down like 90%. Remember, that can happen at any time. And if investors start doubting the Fed will follow through or whether the cuts will be enough, that could lead to volatility and a risk off leg. Now, real interest rates and borrowing burden, even with rate cuts, if inflation remains above nominal rates, so real rates are near zero or negative, this can erode returns on fixed income, hurt savers, and fuel speculative behavior. And borrowing costs for businesses are still elevated because long-term yields and credit spreads haven't responded in lockstep. So the easing effect may still be limited. And the labor market and economic slack are warning signals. The Fed reacting to signs of weakening in labor. These rising unemployment risks often precede or occur during recessions. You can even see it in the tech market, where a lot of these, software developers, junior software developers, are getting laid off, as well as many people that are, in the 20s can barely find entry-level jobs because of AI. That's not happening just for any reason. And consumer spending, corporate investment, and profit margins may already be under pressure. If earnings miss or economic data worsens, it could trigger a cascade of, you know, a recession. And it's already been building up for so long. It's not just like the market is still up and, the stock market is already hitting all-time high prices. The market does not go up forever. You got to consider these economic things that are happening around the world. And before I get to I think one of the final points, keep in mind there's still the war tensions, there's still the tariff tensions going on. This hasn't been resolved yet. People might think that, Trump and China have been, making it cool, but how about Europe? How about the European market? How about, the war effort still happening in Russia? What's going on with the whole world? Keep that in mind. So let's talk about when the bear market might actually happen. What is the possible timing? Well, the first half of 2026 could be calm, you know, with optimistic expectations, falling yields, and possibly a lagged positive impact of rate easing. But the danger likely increases in after Q1, like I mentioned in my Instagram and TikTok video, where I believe there's going to be a bear market, around roughly Q1 of 2026, where late Q2 to Q3 2026, when the Fed's cut, if any, might slow, inflation surprises or other shocks like geopolitical, supply energy hit. Like an energy problem, we can say that, we're building all these data centers, but how about who's going to power these data centers? It takes a lot of energy, and we don't even have any nuclear energy yet. We don't have any other energy sources. So keep that in mind when you're thinking about AI. Like, sure, AI, I'm very bullish on AI in the future, but we still have an energy problem. That's why Trump is investing so much into data centers. There's a reason for that. Or when corporate earnings, began to show damage from earlier tightening. These are the possible signs that a bear market could happen, and it could happen very suddenly, just like in 2022. Another risk window is just after rate cuts, optimism peaks when markets are expecting too much and the Fed signals that cuts won't be as deep or as fast. That disillusionment could often trigger corrections because people, you know, retail goes off of news, right? But we don't get news in advance. That means that if the Fed decides to not cut rates, that could be like, oh yeah, the bear market's already here. We gotta sell all our positions, and that could lead to an even faster crash than anticipated. That's why I know people say don't time the markets, but keep in mind these economic factors are happening around the world and what the Fed could do. So what most people miss is that many view, rate cuts as purely bullish, but they often signal underlying weaknesses. It's not that rate cuts cause crashes, but they accompany conditions like slowing growth, weak labor, inflation are still high. That makes crashes more likely. And the soft landing narrative, slowdown without recession, is optimistic. History shows that soft landing are rare and often illusionary until the storm hits. Like back in 2021, people were just printing money with, stimulus checks and COVID. That could happen again. And investors aren't vigilant. They can be caught off guard by a sell-off, especially in highly leveraged sectors or speculative assets like crypto, high growth technology, etc. And I'm assuming if you watch my channel, you're probably in these speculative assets. So there's a reason why I'm warning you guys right now. I don't want you guys to be holding the bags or, missing out profits. But at the same time, though, you're betting on these speculative positions, which will crash a lot faster than any ETF will. But there's a reason why you're watching the channel because you want to have fast gains. But you had any questions about this whole bear market thing or what my thesis is about it, just give me a comment below and I'll respond when I can. I also have a Discord channel, so if you want to join it and you want real-time stock and crypto calls, access to my full portfolio, become financially free, and join a community of hungry degens, join on my link in bio. You can take a look at all my stock picks on my link in bio. And if you enjoyed the video, subscribe and like for more. But that's all I got for today. I'll catch you guys in the next video. Peace.